Welcome back to our channel. We hope you'll find valuable content here. If you enjoy our channel, please remember to like, subscribe, and stay tuned for more. Let's dive in. Episode 1: Introduction to Financial Reporting. Welcome to the MBA Business School Program channel, where we'll dive into the world of financial reporting and control. In this first episode, we'll embark on our journey by exploring the purpose and importance of financial statements in business decision-making. Why are financial statements important? Imagine you're the captain of a ship, navigating through uncharted waters. To make informed decisions about your journey, you need a map, compass, and a clear understanding of your ship's condition. Similarly, in the business world, financial statements serve as your map, compass, and ship's condition report. The purpose of financial reporting. Communication. Financial statements are a language that businesses use to communicate their financial health and performance to various stakeholders, including investors, creditors, employees, and management. Decision-making. They help decision-makers assess the company's profitability, stability, and growth potential. Just like a navigator uses the map to choose the best route, managers use financial statements to make strategic decisions. Accountability. Financial statements hold businesses accountable for their financial actions. They provide transparency, ensuring that companies can't hide financial troubles or misdeeds. Key components of financial statements. Financial statements consist of three main components. Balance sheet. Think of it as a snapshot of a company's financial position at a specific point in time. It lists assets, what the company owns, liabilities, what it owes, and equity, the owner's stake. The balance sheet helps us gauge a company's solvency and liquidity. Income statement. This document tells the story of a company's financial performance over a period, usually a quarter or a year. It shows revenues, money earned, and expenses, costs incurred. The income statement helps us assess profitability. Cash flow statement. It tracks the flow of cash in and out of a company. This statement is like checking the ship's condition to ensure it's not leaking money. It's crucial for understanding a company's ability to pay its bills and invest in growth. The big picture. Financial reporting is the cornerstone of informed decision-making in business. Whether you're a shareholder evaluating an investment, a manager plotting the company's course, or an employee looking to secure your job, understanding financial statements is essential. By the end of this series, you'll not only decipher these statements, but also use them to navigate the complex seas of financial control and strategy. So, stay tuned as we delve deeper into the fascinating world of financial reporting and control. Your journey to financial mastery has just begun. Episode 2: Generally Accepted Accounting Principles, GAAP. Welcome back to the MBA Business School Program channel. In this episode, we'll delve into the critical foundation of financial reporting, Generally Accepted Accounting Principles, or GAAP for short. What is Generally Accepted Accounting Principles, and why does it matter? Imagine a world where everyone speaks their own unique language. Chaos would ensue, making communication impossible. In the business world, Generally Accepted Accounting Principles acts as the universal language of accounting. It standardizes how financial information is recorded, reported, and interpreted. The purpose of Generally Accepted Accounting Principles. Consistency. Generally Accepted Accounting Principles ensures that financial information is consistent across companies and industries. This consistency allows for meaningful comparisons and analysis. Transparency. It promotes transparency by requiring companies to disclose relevant financial information. This transparency builds trust among stakeholders. Accuracy. Generally Accepted Accounting Principles guidelines are designed to produce accurate and reliable financial statements, reducing the risk of errors and fraud. Key principles of Generally Accepted Accounting Principles. Generally Accepted Accounting Principles is built upon a set of fundamental principles and concepts. Going concern assumes that a company will continue to operate for the foreseeable future. This principle influences how assets and liabilities are reported. Accrual basis, revenue and expenses are recognized when they are earned or incurred, not when cash changes hands. This principle provides a more accurate picture of a company's financial performance. Consistency. Companies should use consistent accounting methods from one period to another. This ensures that financial statements are comparable over time. Materiality. Only significant items need to be disclosed. Small, insignificant details can be omitted to avoid information overload. Prudence, also known as the conservatism principle, it encourages caution when estimating uncertain amounts. This principle helps prevent overstatement of assets or income. Historical cost, most assets and liabilities are initially recorded at their historical cost. This principle provides a reliable and verifiable basis for accounting. Challenges and evolving generally accepted accounting principles. While generally accepted accounting principles is the backbone of financial reporting, it's not static. It evolves to address changing business practices and complexities. New standards, such as the transition to International Financial Reporting Standards (IFRS) in some countries, reflect these changes. As future business leaders, understanding generally accepted accounting principles is essential. It's like mastering the grammar and vocabulary of a language. Without it, meaningful communication is impossible. In the upcoming episodes, we'll explore how generally accepted accounting principles are applied in real financial statements and decision-making processes. So, stay tuned and let's continue our journey into the world of financial reporting and control. Episode 3, Balance Sheet Analysis. Welcome back to the MBA Business School Program channel. In this episode, we'll explore the fascinating world of balance sheets and learn how to analyze them to assess a company's financial position. The balance sheet, a financial snapshot. Think of the balance sheet as a snapshot of a company's financial health at a specific point in time, much like a photograph capturing a moment in time. It provides a clear picture of what a company owns, its assets, what it owes, its liabilities, and what remains for the owners, equity. Understanding assets. Current assets, these are assets that are expected to be converted into cash or used up within a year, such as cash, accounts receivable, and inventory. Non-current assets, also known as long-term assets, these are items that will not turn into cash or be used up within a year, including property, plant, equipment, and investments. Liabilities, the company's debts. Current liabilities, these are obligations that a company must settle within a year, like accounts payable and short-term debt. Non-current liabilities, also known as long-term liabilities, these are debts that will take longer than a year to repay, such as long-term loans and bonds. Equity, ownership and residual value. Equity represents the residual interest in the assets of the entity after deducting liabilities. It includes common stock, retained earnings, and additional paid-in capital. Analyzing the balance sheet. Liquidity, assess the company's ability to meet its short-term obligations by comparing current assets to current liabilities. The higher the ratio, the better the liquidity. Solvency, evaluate the company's long-term financial health by comparing total assets to total liabilities. A ratio greater than 1 indicates solvency. Working capital, calculate working capital as current assets minus current liabilities. Positive working capital suggests a company can cover its short-term liabilities. Debt-to-equity ratio, divide total debt by total equity to gauge the company's leverage. Higher ratios may indicate higher financial risk. Real-world application. Let's consider an example. Company A has $500,000 in current assets and $300,000 in current liabilities. Their working capital is $200,000, $500,000 to $300,000, indicating a healthy short-term financial position. In upcoming episodes, we'll delve even deeper into financial analysis and explore how these numbers can help us make informed decisions. Understanding the balance sheet is like understanding the state of a ship's cargo. It's essential for navigating the financial waters successfully. So, stay tuned for more insights into financial reporting and control. Episode 4: Income Statement and Cash Flow Analysis. Welcome back to the MBA Business School Program channel. In this episode, we'll explore two vital financial statements, the income statement and the cash flow statement. These documents provide a window into a company's financial performance and its ability to generate cash. The income statement, profits and losses. Think of the income statement as the story of a company's financial performance over a specific period, usually a quarter or a year. It tells us how much money the company earned, revenues, and how much it spent, expenses. Key components of the income statement. Revenue: this is the total money earned from the sale of goods or services. It's often referred to as sales or sales revenue. Expenses: these are the costs incurred to generate revenue. Expenses include items like salaries, rent, utilities, and the cost of goods sold, COGS. Gross profit: gross profit is revenue minus the cost of goods sold. It shows how much money is left after covering the direct costs of producing goods or services. Operating income: operating income is the profit generated from a company's normal operations. It's calculated by subtracting operating expenses from gross profit. Net income, also known as the bottom line, this is the final profit after deducting all expenses, including taxes and interest. It represents the company's overall profitability. The cash flow statement, following the money. While the income statement focuses on profits, the cash flow statement tracks the actual flow of cash in and out of a company. It's crucial because profit doesn't always equal cash. Key sections of the cash flow statement. Operating activities: this section shows cash generated or used by a company's core operations. It includes cash from sales and payments for expenses. Investing activities: here, we track cash related to investments in assets, such as purchasing equipment or selling investments. Financing activities: this section covers cash flows from borrowing, repaying debt, issuing or repurchasing stock, and paying dividends. Analyzing the income statement and cash flow statement. Profitability: analyze the income statement to assess the company's profitability. Look at trends over time and compare to industry benchmarks. Cash flow health: examine the cash flow statement to understand how the company manages its cash. Positive cash flow from operations is a good sign. Profit versus cash flow: be aware that profit doesn't always translate into cash. Differences between net income and cash flow should be scrutinized. Real-world application. Imagine Company B reported a net income of $1 million in the last quarter. However, its cash flow from operations was only $800,000 due to slow customer payments. Analyzing both statements helps you see the complete financial picture. In our next episodes, we'll explore financial ratios and metrics that help you evaluate a company's performance and financial health. Understanding these statements is like reading a company's financial diary, and it's essential for making informed business decisions. So, stay tuned for more insights into financial reporting and control. Episode 5: Financial Ratios and Performance Metrics. Welcome back to the MBA Business School Program channel. In this episode, we'll dive into the world of financial ratios and performance metrics, which are powerful tools for evaluating a company's financial health and performance. Why financial ratios matter. Financial ratios are like a magnifying glass for a company's financial statements. They allow us to zoom in on specific aspects of a business to gain deeper insights. Key financial ratios. Liquidity ratios. Current ratio: this ratio compares a company's current assets to its current liabilities. It measures a company's ability to cover short-term debts. Quick ratio, also known as the acid test ratio, it's similar to the current ratio but excludes inventory, providing a more conservative measure of liquidity. Profitability ratios. Gross profit margin, this ratio expresses gross profit as a percentage of revenue. It reveals how efficiently a company produces goods or services. Net profit margin shows how much profit a company retains after all expenses, including taxes and interest. It's a measure of overall profitability. Efficiency ratios. Inventory turnover, this ratio indicates how quickly a company sells its inventory. A high turnover can suggest efficient operations. Accounts receivable turnover, it measures how efficiently a company collects money from customers. Solvency ratios. Debt-to-equity ratio, we discussed this earlier. It shows the proportion of a company's financing that comes from debt compared to equity. Interest coverage ratio, it assesses a company's ability to cover interest payments on its debt from its earnings. Return ratios. Return on assets, ROA measures how efficiently a company uses its assets to generate profit. Return on equity, ROE shows how effectively a company uses shareholder equity to generate profit. Interpreting ratios. Ratios are valuable when compared to industry benchmarks and historical data. For example, if a company's current ratio is 2.0 while the industry average is 1.5, it suggests better liquidity. Real-world application. Let's say company C has a net profit margin of 15%, which is higher than its competitors in the industry, averaging 10%. This indicates that company C is more profitable relative to its revenue. In upcoming episodes, we'll continue to explore how financial ratios and metrics are used for decision-making, risk assessment, and strategic planning. Understanding these ratios is like having a dashboard for your financial analysis, providing valuable insights into a company's performance. So, stay tuned for more insights into financial reporting and control. Episode 6, Revenue Recognition and Expense Measurement. Welcome back to the MBA Business School Program channel. In this episode, we'll delve into the essential topics of revenue recognition and expense measurement in financial reporting. Revenue recognition, the heart of financial reporting. Revenue is the lifeblood of any business. Properly recognizing revenue is crucial because it impacts not only a company's income statement but also its overall financial health. Key principles of revenue recognition. Realization principle, revenue should be recognized when it is earned and realizable. In simpler terms, this means revenue should be recorded when a company has fulfilled its obligations to the customer, and payment is reasonably assured. Matching principle, expenses should be recognized in the same period as the revenue they help generate. This principle ensures that the income statement accurately reflects the company's profitability. Revenue recognition methods, there are various methods for recognizing revenue, such as percentage of completion method, used for long-term projects, it recognizes revenue as work progresses. Completed contract method, recognizes revenue when a project is completed. Sales recognition method, revenue is recognized when a product is sold. Expense measurement, tracking costs. Properly measuring and recording expenses is equally important. It helps companies accurately calculate their profits and make informed financial decisions. Key expense measurement concepts. Matching expenses to revenue, as mentioned earlier, expenses should be recognized in the same period as the related revenue to ensure an accurate representation of profitability. Depreciation, long-term assets like buildings and machinery lose value over time. Depreciation is a systematic way of allocating these costs over the asset's useful life. Amortization, similar to depreciation but applied to intangible assets like patents and copyrights. Real-world application. Imagine Company D sells a subscription service where customers pay upfront for a year of access. According to the realization principle, Company D should recognize revenue monthly, matching it with the service provided. This ensures that the income statement reflects the ongoing performance of the company. Understanding revenue recognition and expense measurement principles is like ensuring that you accurately count and allocate the bricks when building a house. It's essential for constructing a solid financial foundation for your business. In future episodes, we'll continue our exploration of financial reporting and control, so stay tuned for more insights. Episode 7: Asset Valuation Methods. Welcome back to the MBA Business School Program channel. In this episode, we'll explore the various methods used to value assets in financial reporting, including historical cost and fair value. Asset valuation, the basics. Assets are the resources a company owns, and accurately valuing them is essential for presenting a true and fair view of a company's financial position. Key methods of asset valuation. Historical cost, this is the most common method. It values assets at their original purchase cost. While it's straightforward and objective, it may not reflect current market values. Fair value is the current market price at which an asset could be exchanged. It's more relevant for assets like investments and real estate that have readily available market prices. Revaluation model, some companies choose to revalue assets periodically to reflect their current market values. This can lead to fluctuations in asset values on the balance sheet. Depreciation and amortization. When valuing assets, it's essential to consider depreciation for tangible assets, like buildings and machinery, and amortization for intangible assets, like patents and copyrights. Depreciation and amortization allocate the cost of the asset over its useful life. Pros and cons of valuation methods. Historical cost, pros include simplicity and objectivity. Cons include the potential for assets to be undervalued or overvalued compared to current market conditions. Fair value, pros include relevance and accuracy. Cons include subjectivity in determining fair value and potential market volatility. Real-world application. Consider a company, E Corp, that owns a piece of land. If E Corp uses historical cost, the land's value will be what it originally paid for it. However, if E Corp uses fair value, the land's value will be adjusted to its current market price. In upcoming episodes, we'll continue to explore more aspects of financial reporting and control, including liability and equity reporting, financial statement analysis techniques, and ethical considerations. Understanding asset valuation methods is like appraising the value of your possessions. It's crucial for making informed financial decisions. So, stay tuned for more insights. Episode 8: Liability and Equity Reporting. Welcome back to the MBA Business School Program channel. In this episode, we'll delve into liability and equity reporting, two crucial components of a company's financial statements. Understanding liabilities and equity. Liabilities represent the financial obligations a company owes to external parties, while equity represents the ownership interest of the company's shareholders. Key types of liabilities. Current liabilities, these are obligations that a company is expected to settle within 1 year or its normal operating cycle, whichever is longer. Examples include accounts payable, short-term loans, and accrued expenses. Non-current liabilities, these are long-term obligations that are not expected to be settled within the next year. Examples include long-term loans, bonds payable, and deferred tax liabilities. Equity. Equity represents the residual interest in the assets of the company after deducting liabilities. It's essentially the ownership stake in the company. Components of equity. Common stock, the amount of money invested by shareholders when they purchase shares in the company. Retained earnings, accumulated profits that have not been distributed to shareholders in the form of dividends. Real-world application. Imagine Company F has $500,000 in common stock and $1 million in retained earnings. This means that $500,000 represents the initial investments made by shareholders, and $1 million represents the company's accumulated profits over time. Liability and equity reporting in financial statements. Liabilities and equity are reported on the balance sheet, where they contribute to the overall financial position of the company. The balance sheet equation states that assets equal liabilities plus equity, providing a snapshot of the company's financial position. Understanding liabilities and equity is crucial for assessing a company's financial health, solvency, and its ability to meet its obligations. In future episodes, we'll explore financial statement analysis techniques and discuss ethical considerations in financial reporting. Just like understanding the foundation of a building is vital for construction, comprehending liability and equity reporting is essential for building a strong financial understanding. So, stay tuned for more insights into financial reporting and control. Episode 9: Financial Statement Analysis Techniques. Welcome back to the MBA Business School Program channel. In this episode, we'll dive into various financial statement analysis techniques that help us extract valuable insights from financial reports. Why analyze financial statements? Analyzing financial statements goes beyond mere observation. It involves a systematic examination to make informed decisions, assess performance, and identify areas for improvement. Key financial statement analysis techniques. Horizontal analysis. This technique involves comparing financial data over several periods to identify trends and changes. For example, you might compare revenue for the last 5 years to see if it's increasing or decreasing. Vertical analysis. Vertical analysis compares each line item on a financial statement to the total or a key metric. It helps you understand the relative proportion of different items. For instance, you can compare each expense item to total revenue to see what percentage of revenue each expense represents. Ratio analysis. Ratio analysis involves calculating and interpreting various financial ratios to assess different aspects of a company's financial performance. We've discussed liquidity, profitability, efficiency, and solvency ratios in a previous episode. Ratios provide a deeper understanding of a company's financial health. Trend analysis. Trend analysis looks at how financial ratios or line items have changed over time. It's a powerful tool for identifying patterns and potential problems. For instance, if a company's debt-to-equity ratio has been steadily increasing, it may indicate increasing financial risk. Comparative analysis. Comparative analysis involves comparing a company's financial performance to that of its competitors or industry benchmarks. It helps you understand how a company stacks up in its industry. Common size analysis. This technique expresses each line item on a financial statement as a percentage of total revenue. It helps in comparing the relative size of different line items. For example, you can calculate the percentage of cost of goods sold, COGS, relative to total revenue to understand the cost structure. Real-world application. Imagine you're analyzing Company G, a retail business. By using vertical analysis, you discover that their advertising expenses are 10% of total revenue, while their competitors spend only 5%. This insight suggests that Company G might be overspending on advertising relative to its revenue. In future episodes, we'll continue to explore ethical considerations in financial reporting, discuss financial statement fraud detection strategies, and examine more specialized topics. Mastering financial statement analysis techniques is like developing a set of powerful tools for evaluating and improving a business's financial performance. So, stay tuned for more insights into financial reporting and control. Episode 10: Financial Statement Fraud and Ethics. Welcome back to the MBA Business School Program channel. In this episode, we'll discuss the critical topic of financial statement fraud and the ethical considerations in financial reporting. The importance of ethical financial reporting. Ethical financial reporting is the cornerstone of trust in the business world. It ensures transparency and accuracy in financial statements, which are crucial for investors, creditors, and stakeholders. Understanding financial statement fraud. Financial statement fraud involves deliberate manipulation or misrepresentation of financial statements to deceive investors, creditors, or other stakeholders. It can have devastating consequences for a company and its stakeholders. Common types of financial statement fraud. Revenue recognition fraud, inflating revenue or recognizing revenue prematurely to make the company appear more profitable. Expense manipulation, reducing reported expenses to boost profitability. Asset overstatement, overstating the value of assets to inflate the company's financial position. Liability understatement, reducing reported liabilities to make the company seem less indebted. Ethical considerations in financial reporting. Honesty and integrity. Ethical financial reporting begins with the commitment to honesty and integrity. Falsifying or hiding financial information is unethical. Transparency. Transparency involves providing clear, complete, and accurate financial information to stakeholders. Objectivity. Financial reports should be prepared impartially, without bias or undue influence. Professional competence. Those involved in financial reporting must have the necessary skills and knowledge to ensure accurate and ethical reporting. Confidentiality. Financial information should be kept confidential until it's appropriately disclosed. Detecting and preventing financial statement fraud. Internal controls. Strong internal controls and checks and balances can deter fraud and detect irregularities. Independent audits. External auditors can provide an independent assessment of financial statements, helping to uncover fraud. Whistleblower programs. Encouraging employees to report unethical behavior can be an effective way to detect and prevent fraud. Real-world application. Consider a case where Company H artificially inflated its revenue by recording sales that didn't exist. This unethical behavior eventually led to a major scandal and legal consequences for the company's executives. In future episodes, we'll delve into more specialized topics, such as cost behavior and allocation, budgeting and variance analysis, and corporate governance's role in financial reporting ethics. Understanding the risks and consequences of financial statement fraud is essential for maintaining the integrity of financial reporting and fostering trust in the business world. So, stay tuned for more insights into financial reporting and control. Episode 11, Cost Behavior and Allocation. Welcome back to the MBA Business School Program channel. In this episode, we'll explore cost behavior and cost allocation, which are essential concepts in financial reporting and control. Understanding cost behavior. Cost behavior refers to how costs change as a company's activity level or production volume changes. It's crucial to understand how costs behave to make informed decisions and budget effectively. Key cost behavior categories. Fixed costs. These are costs that remain constant regardless of changes in production or sales volume. Rent for a factory space is an example of a fixed cost. Variable costs. Variable costs change in direct proportion to changes in production or sales volume. Raw materials costs in manufacturing are often variable. Semi-variable costs, mixed costs. Semi-variable costs have both fixed and variable components. For example, a salesperson's salary may have a fixed base pay and a variable commission based on sales. Cost allocation, distributing costs. Cost allocation is the process of distributing indirect costs to specific cost centers, products, or projects. It helps in understanding the true cost of producing a product or offering a service. Methods of cost allocation. Direct allocation. In this method, costs are directly assigned to specific cost centers or products. For example, if a factory utility bill is incurred solely for a specific production line, that cost is directly allocated to that line. Activity-based costing. ABC allocates costs based on the activities and resources used by cost centers or products. It provides a more accurate view of how resources are consumed. Real-world application. Imagine Company I manufactures two products, X and Y. To determine the cost of producing each product, the company uses ABC to allocate indirect costs based on the actual activities and resources consumed by each product. This helps company I make pricing and production decisions more accurately. In upcoming episodes, we'll delve into more topics, including budgeting and variance analysis, capital budgeting and investment decisions, and cost-volume profit analysis. Understanding cost behavior and allocation is like having a compass for navigating through the complexities of financial control and decision-making. So, stay tuned for more insights into financial reporting and control. Episode 12, Budgeting and Variance Analysis. Welcome back to the MBA Business School Program channel. In this episode, we'll explore the essential topics of budgeting and variance analysis, which are vital tools for planning and controlling a company's financial performance. The importance of budgeting. Budgeting is the process of setting financial goals and creating a detailed plan to achieve those goals. It's a fundamental component of financial control and helps in making informed decisions. Creating a budget. Revenue budget. This outlines the expected revenue and sales targets for a specific period, usually a fiscal year. Expense budget. This details the planned expenditures across various categories, such as salaries, marketing, and operations. Capital budget. Capital budgeting focuses on long-term investments, like buying new equipment or expanding facilities. Variance analysis, measuring performance. Once a budget is in place, variance analysis helps in comparing actual performance to the budgeted figures. Variances can be either favorable, when actual results exceed budget, or unfavorable, when actual results fall short of the budget. Key steps in variance analysis. Identify variances, determine where and why differences exist between budgeted and actual figures. Is it due to higher expenses or lower revenues? Analyze causes, investigate the root causes of variances. Were they due to unforeseen market changes, production issues, or cost overruns? Take corrective action, if necessary, make adjustments to operations or strategies to address unfavorable variances and capitalize on favorable ones. Real-world application. Consider a scenario where Company J budgeted $100,000 in sales revenue for a quarter but only achieved $90,000. This $10,000 unfavorable variance prompts a deeper investigation into the reasons behind the lower-than-expected sales. In future episodes, we'll continue to explore topics such as capital budgeting and investment decisions, cost-volume profit analysis, and activity-based costing. Understanding budgeting and variance analysis is like having a roadmap and GPS to steer a company towards its financial goals. So, stay tuned for more insights into financial reporting and control. Episode 13, Capital Budgeting and Investment Decisions. Welcome back to the MBA Business School Program channel. In this episode, we'll delve into the critical topic of capital budgeting and how companies make investment decisions to ensure long-term financial success. Understanding capital budgeting. Capital budgeting is the process of evaluating and selecting long-term investment projects that align with a company's strategic goals and create value over time. These projects typically involve significant financial commitments and can shape a company's future. Key considerations in capital budgeting. Cash flow analysis, assessing the expected cash flows generated by the investment, including initial costs and future inflows. Time value of money, accounting for the fact that money received or paid in the future is worth less than money received or paid today. This is often done using techniques like net present value, NPV, and internal rate of return, IRR. Risk assessment, evaluating the risks associated with the investment, including market conditions, competition, and potential economic factors that could impact the project's success. Strategic alignment, ensuring that the investment aligns with the company's long-term strategic goals and objectives. Common capital budgeting methods. Net present value, NPV. NPV calculates the present value of expected cash flows and subtracts the initial investment cost. A positive NPV indicates a potentially profitable investment. Internal rate of return (IRR) is the discount rate that makes the NPV of an investment zero. It's a measure of the project's profitability, with a higher IRR indicating a better investment. Payback period. The payback period calculates how long it takes for the initial investment to be recovered through the project's cash flows. Shorter payback periods are generally preferred. Real-world application. Consider Company K, which is deciding whether to invest in a new manufacturing facility. By conducting a capital budgeting analysis, they estimate the expected cash flows over the project's life, account for the time value of money, and determine the NPV and IRR of the project. This helps them decide whether the investment is financially viable. In upcoming episodes, we'll continue to explore more topics, such as cost-volume profit analysis, activity-based costing, and internal control systems. Understanding capital budgeting is like having a compass for navigating the complex landscape of long-term financial decision-making. So, stay tuned for more insights into financial reporting and control. Episode 14, Cost-Volume Profit, CVP, Analysis. Welcome back to the MBA Business School Program channel. In this episode, we'll explore cost-volume profit, CVP, analysis, a powerful tool for understanding how changes in costs, volume, and prices impact a company's profitability. Understanding cost-volume profit analysis. Cost-volume profit, CVP, analysis is a financial modeling technique that helps businesses assess the relationship between costs, sales volume, and profit. It's particularly useful for making pricing decisions, setting sales targets, and understanding the break-even point. Key components of cost-volume profit analysis. Fixed costs. These are costs that do not change with changes in production or sales volume. Examples include rent and salaries. Variable costs. Variable costs change in direct proportion to changes in production or sales volume. Raw materials costs are an example. Contribution margin. This is the difference between total sales revenue and variable costs. It represents the portion of revenue available to cover fixed costs and contribute to profit. Break-even point. The break-even point is the level of sales at which a company covers all its costs and neither makes a profit nor incurs a loss. Applications of cost-volume profit analysis. Setting sales targets. Cost-volume profit analysis helps in determining the number of units a company needs to sell to reach its desired profit levels. Pricing decisions. By understanding how changes in price affect contribution margin and, consequently, profit, companies can make informed pricing decisions. Cost control. Cost-volume profit analysis helps identify cost structures and areas where cost reductions may be necessary to improve profitability. Real-world application. Consider a software company, Company L, which sells licenses for its software. By using cost-volume profit analysis, they can determine the minimum number of licenses they need to sell to cover their fixed costs and start making a profit. This analysis helps them set realistic sales targets and pricing strategies. In future episodes, we'll explore more topics, such as activity-based costing, internal control systems, and auditing and assurance services. Understanding cost-volume profit analysis is like having a financial crystal ball that helps predict the impact of various decisions on your company's bottom line. So, stay tuned for more insights into financial reporting and control. Episode 15, Activity-Based Costing, ABC. Welcome back to the MBA Business School Program channel. In this episode, we'll explore activity-based costing, ABC, a method used to allocate costs based on activities and resource consumption, providing a more accurate understanding of cost structures. Understanding activity-based costing, ABC. Traditional costing methods often allocate overhead costs based on a single cost driver, such as machine hours or labor hours. Activity-based costing, on the other hand, recognizes that not all activities consume resources in the same way, and it allocates costs based on multiple cost drivers. Key components of activity-based costing. Activities, these are the tasks or processes that consume resources. Activities can be divided into two categories: unit-level activities, related to individual units produced or services provided, and batch-level or product-level activities, related to groups of units or products. Cost pools are categories of costs associated with specific activities. These can include costs related to setup, inspection, or maintenance, among others. Cost drivers are the factors that determine the level of activity within an activity cost pool. For example, the number of setups might drive setup-related costs. Benefits of activity-based costing. Accurate cost allocation. Activity-based costing provides a more precise way of allocating costs, helping companies understand the true cost of products, services, or activities. Informed decision-making. With a clearer picture of cost structures, organizations can make better decisions about pricing, product mix, and process improvements. Resource efficiency. Activity-based costing can highlight areas where resources are underutilized or overutilized, enabling companies to optimize their operations. Real-world application. Imagine Company M manufactures various products, and they initially allocate overhead costs based solely on machine hours. However, they implement activity-based costing and discover that certain products require more setup time, inspection, and handling than others. Activity-based costing reveals the true cost of each product, allowing them to make informed pricing and production decisions. In upcoming episodes, we'll explore topics like internal control systems, auditing and assurance services, and managerial accounting techniques. Understanding activity-based costing is like having a pair of precision scales to weigh the true cost of your company's activities. So, stay tuned for more insights into financial reporting and control. Episode 16: Internal Control Systems. Welcome back to the MBA Business School Program channel. In this episode, we'll explore the importance of internal control systems in financial reporting and control. What are internal control systems? Internal control systems are processes and procedures put in place by organizations to safeguard their assets, ensure the accuracy of financial information, and promote operational efficiency. These systems are essential for preventing errors, fraud, and mismanagement. Key components of internal control systems. Control environment. This sets the tone for the organization's internal control system, emphasizing the importance of integrity and ethical values. It includes factors like management's philosophy and the company's culture. Risk assessment. Identifying and analyzing risks is crucial. Companies must understand potential vulnerabilities to implement effective controls. Control activities. These are specific policies and procedures designed to mitigate risks. Examples include segregation of duties, ensuring no one person has too much control, authorization processes, and regular reconciliations. Information and communication. Effective communication ensures that information about controls and risks is shared throughout the organization. It includes both internal and external communication. Monitoring. Monitoring involves ongoing assessments of the internal control system's effectiveness. It includes management reviews, internal audits, and corrective actions. Benefits of internal control systems. Risk mitigation. Internal controls help identify and mitigate risks that could lead to financial losses, fraud, or operational disruptions. Accuracy and reliability. They enhance the accuracy and reliability of financial reporting, which is critical for decision-making and investor trust. Operational efficiency. Controls promote efficiency by streamlining processes and reducing the likelihood of errors. Real-world application. Consider Company N, which implements internal controls to ensure that financial transactions are properly authorized and recorded. They also perform regular reconciliations and have an internal audit team that periodically reviews their control procedures. This proactive approach helps Company N maintain financial integrity. In future episodes, we'll delve into more topics, including auditing and assurance services, managerial accounting techniques, and corporate governance's role in financial reporting ethics. Understanding internal control systems is like having a security system in place to protect your company's financial well-being. So, stay tuned for more insights into financial reporting and control. Episode 17, Auditing and Assurance Services. Welcome back to the MBA Business School Program channel. In this episode, we'll explore auditing and assurance services, which play a critical role in evaluating and ensuring the accuracy of financial statements. What is auditing? Auditing is an independent examination of a company's financial statements, transactions, and internal controls by a qualified auditor. The primary purpose of auditing is to provide assurance that the financial statements are free from material misstatements and fairly present the company's financial position. Key elements of auditing. Independence. Auditors must be independent from the company they are auditing to ensure objectivity and impartiality. Audit opinion. After the audit, the auditor provides an opinion on the fairness of the financial statements. This can be an unqualified opinion, meaning the statements are fairly presented, a qualified opinion, indicating some issues, or an adverse opinion, indicating significant issues. Audit procedures. Auditors use a variety of procedures, including testing transactions, reviewing internal controls, and sampling, to gather evidence and support their opinion. Assurance services. In addition to financial statement audits, auditors may provide assurance services in other areas, such as cybersecurity, sustainability reporting, and compliance with regulatory requirements. These services offer stakeholders confidence that certain aspects of a company's operations are being conducted effectively and in compliance with relevant standards. Benefits of auditing and assurance services. Trust and credibility. Audited financial statements provide a higher level of trust and credibility to investors, creditors, and other stakeholders. Risk mitigation. Auditors help identify and mitigate financial and operational risks. Compliance. Assurance services help companies adhere to regulatory requirements and industry standards. Real-world application. Company O engages an independent auditor to conduct an annual audit of its financial statements. The auditor reviews the company's financial records, assesses internal controls, and provides an audit opinion. This opinion assures stakeholders that the financial statements are accurate and reliable. In upcoming episodes, we'll explore more topics, including managerial accounting techniques, corporate governance's role in financial reporting ethics, and financial reporting in specialized industries. Understanding auditing and assurance services is like having an impartial referee to ensure that the financial reporting game is played fairly and by the rules. So, stay tuned for more insights into financial reporting and control. Episode 18, Managerial Accounting and Decision Making. Welcome back to the MBA Business School Program channel. In this episode, we'll explore the world of managerial accounting and how it helps organizations make informed internal decisions. What is managerial accounting? Managerial accounting, also known as management accounting, focuses on providing information and analysis to internal decision makers within an organization. Unlike financial accounting, which is primarily concerned with external financial reporting, managerial accounting's audience is the company's management team. Key aspects of managerial accounting. Cost analysis. Managerial accountants analyze the cost of producing goods or services, helping managers understand cost structures and make pricing decisions. Budgeting. Managerial accountants play a crucial role in creating budgets, which serve as financial roadmaps for the organization's future operations. Performance measurement. They design performance metrics and key performance indicators, KPIs, to assess how well the organization is meeting its goals. Decision support. Managerial accountants provide data and analysis to support various decisions, such as product pricing, production planning, and investment choices. Key tools in managerial accounting. Cost volume profit, CVP, analysis. as we discussed in a previous episode, CVP analysis helps in understanding how changes in costs, volume, and prices impact profitability. Variance analysis. Variance analysis involves comparing actual performance to budgeted figures to identify discrepancies and take corrective action. Real-world application. Imagine Company P is deciding whether to launch a new product line. Managerial accountants assess the projected costs, potential sales, and expected profits associated with the new product. This analysis helps the company's management team decide whether the investment is justified. In future episodes, we'll explore more topics, including performance measurement and balance scorecards, transfer pricing and global operations, and financial reporting in specialized industries. Understanding managerial accounting is like having a GPS for internal decision-making, guiding organizations toward their strategic goals. So, stay tuned for more insights into financial reporting and control. Episode 19, Performance Measurement and Balanced Scorecards. Welcome back to the MBA Business School Program channel. In this episode, we'll explore performance measurement and balanced scorecards, which are tools used by organizations to evaluate and manage their performance effectively. Performance measurement, why it matters. Performance measurement is essential for assessing how well an organization is meeting its goals and objectives. It provides valuable insights into areas that need improvement and helps align activities with strategic priorities. Key components of performance measurement. Key performance indicators, KPIs. These are specific metrics or indicators used to track progress toward achieving goals. KPIs can vary widely depending on the organization and its objectives. Benchmarking. Benchmarking involves comparing an organization's performance against that of its peers or industry standards. It helps identify areas where the organization can improve. Balanced scorecards, a holistic view. The balanced scorecard is a comprehensive framework for performance measurement that goes beyond financial metrics. It includes 4 key perspectives. Financial perspective. This perspective focuses on traditional financial metrics like revenue, profit, and return on investment. Customer perspective. It assesses how the organization is perceived by its customers and how well it's meeting their needs and expectations. Internal process perspective. This perspective evaluates the efficiency and effectiveness of internal processes and operations. Learning and growth perspective. It looks at the organization's ability to adapt, innovate, and develop its people and capabilities. Benefits of balanced scorecards. Holistic view. Balanced scorecards provide a more comprehensive understanding of performance, considering financial and non-financial aspects. Alignment. They help align various functions and departments within an organization with its strategic objectives. Communication. Balanced scorecards facilitate communication and understanding of strategic goals throughout the organization. Real-world application. Company Q uses a balanced scorecard to measure its performance. In addition to tracking financial metrics like revenue and profit, they assess customer satisfaction, internal process efficiency, and employee development. This approach provides a well-rounded view of the company's overall performance. In upcoming episodes, we'll explore more topics, such as transfer pricing and global operations, corporate governance's role in financial reporting ethics, and financial reporting in specialized industries. Understanding performance measurement and balanced scorecards is like having a dashboard to monitor and steer your organization towards success. So, stay tuned for more insights into financial reporting and control. Episode 20, Transfer Pricing and Global Operations. Welcome back to the MBA Business School Program channel. In this episode, we'll explore the complex but crucial topic of transfer pricing in the context of global operations. What is transfer pricing? Transfer pricing refers to the pricing of goods, services, or intellectual property transferred between different entities within the same multinational company. This is particularly relevant when a company operates in multiple countries. Key considerations in transfer pricing. Arm's length principle. transfer prices should be set as if the transactions were between unrelated, independent entities. This principle ensures fairness and avoids potential tax evasion. Compliance with tax laws. Companies must adhere to the tax laws and regulations of each country in which they operate. Transfer pricing can significantly impact a company's tax liabilities. Transfer pricing methods. There are various methods for determining transfer prices, including comparable uncontrolled price, CUP, resale price method, and cost-plus method. The choice of method depends on the nature of the transaction. Challenges of transfer pricing. Complexity. Determining appropriate transfer prices can be complex, especially when dealing with intangible assets or unique products. Compliance. Ensuring compliance with various tax laws and regulations across different countries can be challenging and requires careful documentation. Tax optimization. While legal, transfer pricing can also be used for tax optimization, which can raise ethical questions. Real-world application. Consider a multinational tech company, Company R, with operations in several countries. It licenses its software to subsidiaries in different countries. Setting the transfer price for these licenses involves considerations like the value of the intellectual property and local tax laws. Company R must carefully document these transactions to comply with tax regulations and avoid disputes with tax authorities. In future episodes, we'll explore more topics, including corporate governance's role in financial reporting ethics, financial reporting in specialized industries, and financial reporting and control strategy. Understanding transfer pricing is like navigating a complex web of international tax regulations to ensure that global operations run smoothly. So, stay tuned for more insights into financial reporting and control. Episode 21. Corporate Governance and Financial Reporting. Welcome back to the MBA Business School Program channel. In this episode, we'll delve into the critical role of corporate governance in ensuring accurate and ethical financial reporting. What is corporate governance? Corporate governance refers to the system of rules, practices, and processes by which a company is directed and controlled. It involves balancing the interests of various stakeholders, including shareholders, management, customers, suppliers, financiers, government, and the community. The role of corporate governance in financial reporting. Accountability. Corporate governance ensures that those responsible for a company's financial reporting are held accountable for their actions. This accountability helps prevent financial misconduct and fraud. Transparency. Transparency is a key principle of corporate governance. It requires companies to provide clear, accurate, and timely information to shareholders and other stakeholders. Ethical behavior. Good corporate governance promotes ethical behavior throughout the organization, reducing the likelihood of unethical financial reporting practices. Effective risk management. It helps companies identify and manage risks, including those related to financial reporting, more effectively. Key aspects of corporate governance. Board of Directors. The board plays a central role in corporate governance. It oversees the company's management and ensures that the interests of shareholders are protected. Audit committees. Audit committees, composed of independent directors, are responsible for overseeing the company's financial reporting process and the integrity of its financial statements. Shareholder rights. Corporate governance often includes measures to protect the rights of shareholders, such as voting rights and access to information. Real-world application. Consider Company S, which has a robust corporate governance structure in place. They have an independent board of directors, an audit committee that reviews financial reporting processes, and regular communication with shareholders. This approach helps maintain trust and confidence in the company's financial reporting. In upcoming episodes, we'll explore more topics, including financial reporting in specialized industries, financial reporting and control strategy, and other advanced concepts. Understanding corporate governance is like having a strong foundation for ethical and transparent financial reporting, which is essential for long-term business success. So, stay tuned for more insights into financial reporting and control. Episode 22, Earnings Management and Financial Reporting Quality. Welcome back to the MBA Business School Program channel. In this episode, we'll delve into the complex issues surrounding earnings management and financial reporting quality. What is earnings management? Earnings management refers to the practice of deliberately manipulating a company's financial statements to achieve specific financial goals or meet investor expectations. While some earnings management may be legal and acceptable, it can also cross ethical boundaries and harm financial reporting quality. Ethical considerations in earnings management. Income smoothing. Some companies engage in income smoothing to create a more consistent pattern of earnings over time. This can reduce investor uncertainty but may hide underlying financial issues. Big bath accounting. Companies may take significant write-offs in a single period to create future periods of artificially improved earnings. This practice can mislead investors about the company's true financial health. Cookie jar reserves. Companies may set aside reserves in good years and use them to boost earnings in challenging years. This can distort the accuracy of financial statements. Impact on financial reporting quality. Earnings management, especially when done unethically, can undermine the quality and integrity of financial reporting. It can lead to misleading financial statements, erode investor trust, and even result in legal and regulatory consequences. Detecting and preventing earnings management. Transparent disclosure. Companies should provide clear explanations for any unusual or non-recurring items in their financial statements. Independent auditors. External auditors play a crucial role in detecting earnings management practices and ensuring compliance with accounting standards. Regulatory oversight. Regulatory bodies like the Securities and Exchange Commission (SEC) in the United States monitor and investigate potential earnings management cases. Real-world application. Company T faced financial difficulties and engaged in earnings management by recognizing revenue prematurely to boost its reported earnings in the short term. This strategy temporarily improved the company's financial appearance, but ultimately resulted in financial distress and regulatory penalties. In upcoming episodes, we'll explore more advanced topics, including financial reporting in specialized industries, financial reporting and control strategy, and the strategic role of financial reporting in business. Understanding earnings management and its impact on financial reporting quality is crucial for maintaining trust and transparency in the business world. So, stay tuned for more insights into financial reporting and control. Episode 23. Financial Reporting in Specialized Industries. Welcome back to the MBA Business School Program channel. In this episode, we'll explore the unique considerations and challenges of financial reporting in specialized industries, such as healthcare and technology. Healthcare industry financial reporting. Regulatory complexity. Healthcare companies must navigate a complex regulatory environment, including compliance with the Health Insurance Portability and Accountability Act, HIPAA, in the United States. This adds an extra layer of complexity to financial reporting. Revenue recognition. Revenue recognition in healthcare can be challenging due to factors like insurance reimbursements, patient copays, and government programs. Proper accounting for these revenue streams is critical. Technology industry financial reporting. Intangible assets. Technology companies often have substantial intangible assets, such as patents and copyrights. Proper valuation and accounting for these assets are essential for accurate financial reporting. R&D expenses. Research and development expenses play a central role in technology companies. These expenses must be accounted for correctly to reflect ongoing innovation efforts. Real-world application. Imagine Company U, a healthcare provider, faces the challenge of accurately reporting revenue from various sources, including insurance reimbursements, private payers, and government programs. They must also ensure compliance with healthcare industry regulations, making financial reporting a highly specialized and complex task. In upcoming episodes, we'll explore more advanced topics, including financial reporting and control strategy, and the strategic role of financial reporting in business. Understanding financial reporting in specialized industries is like speaking the unique language of each industry, ensuring that financial statements accurately reflect their operations and challenges. So, stay tuned for more insights into financial reporting and control. Episode 24, Corporate Social Responsibility, CSR, Reporting. Welcome back to the MBA Business School Program channel. In this episode, we'll explore corporate social responsibility, CSR, reporting and how companies disclose their social and environmental impact in financial statements. What is corporate social responsibility reporting? Corporate social responsibility reporting, also known as sustainability reporting, is the practice of disclosing a company's social and environmental performance alongside its financial results. It provides stakeholders with information about a company's efforts to operate responsibly and sustainably. Key elements of corporate social responsibility reporting. Environmental impact. Companies report on their efforts to reduce their environmental footprint, including initiatives related to carbon emissions, energy efficiency, and waste reduction. Social initiatives. Corporate social responsibility reports often highlight a company's social initiatives, such as community engagement, employee well-being programs, and diversity and inclusion efforts. Governance and ethics. Reporting includes information about corporate governance practices and ethical standards. This can involve disclosures about board composition, executive compensation, and anti-corruption measures. Benefits of corporate social responsibility reporting. Transparency. Corporate social responsibility reporting enhances transparency and demonstrates a company's commitment to responsible business practices. Reputation. It can improve a company's reputation, making it more attractive to customers, investors, and socially conscious employees. Risk management. Corporate social responsibility reporting helps companies identify and manage environmental and social risks that can impact their operations and financial performance. Real-world application. Company V, a global manufacturer, includes corporate social responsibility reporting in its annual financial statements. They disclose their efforts to reduce carbon emissions, improve supply chain sustainability, and support local communities where they operate. This information not only informs stakeholders but also aligns with the company's values and business strategy. In the final episode of this program, we'll discuss the strategic perspective of financial reporting and control, emphasizing its role in overall business strategy. Understanding corporate social responsibility reporting is like adding a new dimension to financial reporting, one that reflects a company's commitment to a better future. So, stay tuned for more insights into financial reporting and control. Episode 25, Financial Reporting and Control Strategy. Welcome back to the MBA Business School Program channel. In this episode, we'll discuss the strategic perspective of financial reporting and control, emphasizing its role in overall business strategy. Integrating financial reporting and control with business strategy. Financial reporting and control are not just about numbers, they are integral to a company's strategic decision-making. Here's how. Setting strategic goals. Financial reports provide insights into the company's financial health and performance, helping set realistic and achievable strategic goals. Resource allocation. Effective control systems ensure that resources are allocated efficiently to support the strategic initiatives that drive growth and profitability. Risk management. Financial controls help identify and manage risks associated with strategic decisions, ensuring the company can navigate uncertainties. Performance evaluation. Financial reports allow the company to measure its progress towards strategic objectives and make necessary adjustments. Stakeholder communication. Transparent financial reporting builds trust with stakeholders, including investors, creditors, and employees, which is vital for executing strategic plans. Strategic financial reporting considerations. Long-term perspective. companies should not focus solely on short-term financial results, but consider the long-term impact of their strategic decisions. Scenario planning, scenario analysis and sensitivity analysis in financial reporting help assess how different strategies might perform under various economic conditions. Key performance indicators, KPIs. Identify and track KPIs that align with the company's strategic priorities to ensure that progress is measured effectively. Real-world application. Company W, a tech startup, integrates financial reporting and control into its strategy from the beginning. They use real-time financial data to make quick adjustments to their product development, marketing, and expansion plans. This agile approach helps them stay on track and adapt to changing market conditions. Understanding the strategic perspective of financial reporting and control is like having a compass that guides a company toward its desired destination and helps it navigate the ever-changing business landscape. It's the culmination of our journey through the world of financial reporting and control. Thank you for joining us in this program, and we hope these episodes have provided you with valuable insights into the complex yet essential field of financial reporting and control. If you have any more questions or need further information, please feel free to ask.